currencies basically help us where we have multi-currency transactions within our business. And it's important we understand things like currencies, exchange rate types, evaluations, posting profiles, and the rest of them. So when you're transacting in other currencies, then you have to activate your currency transaction. So you can see a flow. We have three types of currencies in Dynamics. One, we have let me reduce this a little. One, we have the transactional currency, which is recorded in, transactional currency is, the currency you use at the point of doing your transaction with the client. So if you have a client in the US and you transact with that and you raise invoices in USD, that USD is your transactional currency. Right. Again, we have the accounting currency, which is basically converted, which is your home currency. So converted using accounting currency and exchange rate type. So for example, your accounting currency is the currency you use to do your reporting. Right. Transaction currency is the currency you use to transact. It's what sits on your invoices when you raise transactions. While accounting currency is what you use to account as per. This is the financial status of our business. So if, for example, you are in United Kingdom and that is where you do your financial reporting, that is your accounting currency. And then we have reporting currency, which is used for group reporting. So again, this is basically where you have a group. So for example, if we have a group company in the UK and we have other companies in other countries, those countries' accounting currency will be their local currency. However, when we want to do group reporting will be the currency of the group, of the location of the group company. So if the company is located in Germany, German currency would be the reporting currency, the group reporting currency. So again, these are different kinds of currencies that we can set up, that we can find in the system. Just to make it a little bit simple, one, accounting currency, again, is the primary currency you use to record all financial transactions. It's like your transactional currency, or it's your transactional currency. Two, reporting currency is the secondary currency used for financial reporting. And it's important that, especially if you want to report at group level or at local current or at company reporting level. An accounting currency exchange rates is the exchange rate that is defined. So for example, if we're based in the UK and our accounting currency is GBP, and we're doing business with somebody in the US, which is USD, in the system, we have to define what is the exchange rate between USD and GBP, or GBP and USD, so that when the invoice comes in, the system will use the exchange rate to translate USD into GBP, so that at accounting level, we can see the GBP value, and at transactional level, we can see USD. Why it helps is in UK, you report based on your accounting currency, based on your home currency, or based on your reporting currency. So whatever currency that is coming from any other currencies will need to be translated into GBP for us to be able to do reporting. So that's why we need to make sure that exchange rate is set up on the system, so that the system is able to convert those external currencies into our accounting currency or our reporting currency. So again, you can see there, the amount in the transactional currency times the exchange rates is what we call the amount in accounting currency times the reporting exchange rate is the amount in reporting currency. If you see the formula just at the bottom, amount in transactional currency times the exchange rate gives you amount in accounting currency, which is what you use to record all your transactions. And then if you multiply it times the reporting exchange rate, it gives you amount in reporting currency. So accounting currency is what we use to record all our financial transactions, and of course, report at local level. Reporting currency is also a currency that is used to do our financial reporting. It could be at group level, it could be at company reporting level. So again, all this will have to be defined at a requirement gathering. When you're discussing with your business, you ask, what is your accounting currency? What is your reporting currency? And of course, that will be clear as you do your, and of course, how do you define exchange rates in the system so that the system can do the translation? Okay, so we have, we have this, and we want to go deep into this, define all this. Okay, this is a clearer version. Sorry for, there was a glitch in my system. I think it duplicated some stuff. Okay, let's go into the system and then define what our currencies would be. So if you go to currencies, first, remember we're in a general ledger, go to currencies, and then you're going to see some core functionalities that you can work with. Now we have, first, you can go to currencies to see the list of all the currencies we have in the system. So if you try to, probably all the currencies in the world are already here. So BBP is here, USD is here, and of course other currencies are. If you are not here, you can create, and nothing much really. So currencies are existing, that's good. Exchange rate type. So here you can see the different exchange rate type. We have average, budget, closing, constant, default. Now, again, I want to go deep into this, but exchange rate type is basically how does the system convert, convert local currency to reporting currency, or how does the system translate that external currency to your accounting or your reporting currency. Normally, if you check, all these have some formulas on how it does the calculation. That's why most times we see it on the default or the average rate. So it does the rate of 2 divided by the currency amount. You can do some more research on these different rates and we can share that, but I don't want to go also deep into this. Then you have here exchange rates. You can see all the exchange rates that are defined in the system: Euro to USD, GBP to Naira, USD to this. So there's no GBP to USD. So if you want to define that, again, we can just see how that was done. We can click on new. Just make sure we look at the exchange rate. Yeah, if you click on new, we want to define GBP to USD and leave the conversion rate to 1. I don't know why it's graded out. Let me see. Okay. I think I will need to save this and then, okay, they already exist. Oh, okay, that's why. So I think we have to, is it here? Can't find it here, I guess. The already has it defined. EU to USD. Oh, okay, this is it. Okay. All right. So again, you can click on, we can do, let's see the one that is not there. USD to Naira is not here. So let's try that. So foreign currency, we'll say USD to the local currency, which is Naira, NGN. Yes. And then from when is it starting? You can say it's starting from the 1st, and you can select the date. Let's say starting from 1st of May. Then you put the exchange rate. I think it's about 1.8, 1.850. Let me just put this. So 1.8, this thing Naira, 1.850 Naira to 1 USD. If you're done, you click on save. So we now have USD to Naira system set up on our system. So that's how you can define exchange rates. Again, we went through a shortcut here. You can also go here. We went through okay, yeah, went through exchange rates. Then these are all the list of exchange rates we have. We've said that before. Um, then I think exchange rate types, we have talked about that. We can see foreign exchange revaluation. This will happen when we have transactions in different currencies. So what is foreign currency revaluation? Now, because of the fluctuations in exchange rates, when you have entered, for example, you have created a customer invoice at a rate of, let's say, between GBP and USD, say one USD, let's say 3 USD is equals to 1 GBP. You have done that in the middle of the month, then at the end of the month, the rate changed to 1.5 at the point of wanting to receive the money, right? So again, you have to do your foreign currency revaluation to update what the new exchange rate is, and then that's where you have gain or loss. So if the exchange rate goes up and your client pays you based on that new exchange rate, you have a plus. If the rate comes down and your client pays you based on the low exchange rate, sorry, the first one is a gain. The last one is a loss. If the rate comes down and your customer pays you based on the prevailing exchange rate, then you have a loss because the rate has come down. But if the rate goes up and you're receiving payment when the rate has gone up, then you have an exchange rate gain. So we have those two activities happening within the system. Again, foreign currency revaluation is updating your transactions based on the current exchange rate. But that will happen when we have transactions. So basically, that's what we need to talk about currencies. You can import currencies. You can configure exchange rate providers. What this does is automatically the system updates the exchange rate in your system instead of us going out every month to be changing the rates. So for example, if we're doing it manually, when we go to exchange rate, we'll come here and then say, oh, the new exchange rate we change it here. But if we use that configuration, the system will automatically update with the new exchange rate, so we don't have to do that. So again, that's very important to us setting up currencies, and we have set up chart of accounts, we have set up the currencies, we have set up the calendar, and then the next thing is to do ledger setup. Very, very important. Do we have any questions at this point? Okay, please use the chat. Let me see if I have anything on the chat. Oh, thank you for sending that double entry stuff. Yeah, so after you have set up, remember our structure. Remember, we're just plugging in things for now. So this is account structure, which is one we need to plug in, then we'll start the tax for today when we come back. So let's just finish with structures and then we'll go for a break and then now start doing some good hands-on exercise. So go to ledger setup and go to ledger. Again, let's see what ledger setup is all about. And then, it helps us just understand the concept better. So ledger setup in D365 defines the core financial configuration, including ledger, fiscal calendar, and accounting periods, reporting setup. So it's all in one. So it's where we integrate chart of accounts, we integrate fiscal calendars, and we integrate reporting requirements, and of course exchange rates. But that's not important. So now what we have done before now, just to explain, so it also makes sense, is we have created structures, but we have not mapped them together. So we have created. So for this house, for this entity, we have created chart of accounts, we have created fiscal period, we have created currencies, but they are standing on their own. The system has not, we have not brought them together so that they can work together, so that they can form part of the structure in this building. or in this entity. So what brings these three together is what we call the accounting structures. Or in other words, your ledger. So if you check here, if you go here, you see, no, let me just use ledger setup so it's clear. So your ledger setup is what brings all of them together to form one structure. If you don't do this, then you can't use them because they have still not been brought together so that the system it has not been plugged into the entity. Let me use that. So remember, just imagine you bought a laptop and it's dead. The only way that laptop can come to life is when you plug it into a power source. So for now, these entities are dead, or they are just standing on their own. Nothing is communicating with them. The only thing that will make this entity fit into this the only thing that will make these structures, these items we have created fit into this structure is when we bring them together through the ledgers. So that's just to give you clarity on the integration between chart of account, fiscal year, and currencies. There are three core things that must be defined and linked together for you to be able to use the system. It took me a lot of time to understand this because, unfortunately, when you go for certain trainings, they just train you, and we're just doing stuff. I didn't understand how these things were connected. So again, remember the building and the fact that it's like if you want to do a bridge, now you understand that in doing a bridge, sometimes there are joints and connections that needs to happen. So it is, and then when you have done those joints, you can now mount it to the structure so that it stands as a bridge. Again, we have created all those joints, and we have the most important thing now is to bring them together so that they can be part of, so that you can now say you have a bridge. If you don't bring them together, you don't have a bridge, right? So again, this is very, very important. Understanding this is very important because without chart of accounts, you cannot do any transaction. You can't do supply chain. You can't do anything without chart of accounts. You can't do anything without fiscal year. And of course, if you have multiple entities, you can't do anything if you have not set up your currency structure. But if you have created them individually and you have not mapped them together through accounting ledger structure, then you cannot use them. The system will throw up errors. So let's do the mapping. Okay, sorry, on the yes. Again, let me see. So I've defined that, and let me see if we have. So if you see here the ledger setup, which we are going to be going into soon, we have, almost 11 things you can talk about. So one, if you look at the ledger setup, core setup for legal entity, define accounting currency,